What's good, y'all? It's Alex Kamunyo here, and I'm back with another video. And today I'm gonna be talking about whether you should focus on paying off debt or focus on investing. If you're new to this channel, then it's all about earning money, saving money, and investing your money to achieve financial freedom. If you haven't been rocking with us and you don't know what financial freedom is, then financial freedom is the ability to live off of passive income from assets that you've invested in so that you don't have to trade in your time for money at a job. Let's get into today's video.
I guess I got my swagger back.
Real quick before we get into the video, I want to say shout out to Bravado Life for the merch that I'm rocking right now. You can't fire me, the boss. But now let's get into the video. So this topic is something I get asked about all the time. You know, people come and they say, hey Alex, should I, I got student loans, I got credit card debt, I got a car loan. Should I pay this off or should I start, investing in real estate, getting in the stock market, starting a business, or whatever it may be? Which one should I be focusing on? And so it's a warranted, it's a really popular debate right now. And I can understand why there will be a lot of questions, right? Stay to the end if you want to hear my, actual take on what you should do and what I think people should do. So the first thing you need to actually look at and think about whenever you're considering investing or paying off debt is the interest rate, right? Is it high interest debt? Is it low interest debt? And by high interest debt, I'm typically talking like above 10, 12%. Anything below that is more so low interest debt. The reason I say the interest rate needs to be considered is because we've all heard the phrase that a penny saved is a penny earned, or a dollar saved is a dollar earned. I mean, that is 100% facts, because if I was going to go and spend that money on interest or on anything else, but now I get to keep it, that is money now that I get to essentially use for something else, right? It's being planned for something else, as opposed to being used on another item, right? So you get to keep that money. And so that's why that phrase exists, because it's really true. And so the reason this is important is because if you think about it, right? Think about if you had, let's say, a credit card with 25% APR, 25% interest that you're paying on there, then paying that debt down will be essentially a guaranteed 25% ROI in a sense annually, because now that money you would have spent on the interest now gets to be kept in your pocket. And so that's money now that you can use on other things or other investments. So it's a guaranteed 25% ROI. You really have to look at it from the opposite perspective, right? Think about if you're a creditor or someone that lends out money, and you lend out money at 25%, and now the person that you lent money to says, no, I'm going to pay this off early instead of, holding it for the time of this loan. That person that's lent the money out, they now lost their 25% ROI, right? And so if they lost it, someone else had to gain it. And so now you as the consumer, you gain that 25% ROI, right? So that's why you had to really look at that and say, if you have high interest debt, you need to pay that joint down. I don't know, you don't even need to be playing with nothing else. Like if you got 25% debt sitting anywhere right now and you're watching this video, get off this video and go pay that debt down. But if it's not that simple and you might have lower interest debt, then it's a different story now. So another question you really need to ask yourself is, can you get a better ROI than what that interest rate is on that debt? If you cannot get a better ROI than that, then you should probably pay the debt down. So if we're talking 25%, more than likely, most people are not gonna be able to get a better ROI than 25% when they go invest it somewhere else. The stock market typically averages 6 to 8%. And if you're gonna plan to invest in the stock market and you got 25% interest debt, your priorities are mixed up. Now, if you have low interest debt, like let's say student loans, it's a different story, because now you could possibly get a better ROI than that low interest debt. If you got 4% student loans, you can maybe get 7% in the stock market and net that 3%, right? And still be able to pay that debt down. So that is a different story. But if you have high interest debt, you need to pay that debt down. End of story. The first question you should be asking yourself is, what kind of debt is it? So the reason this is an important question to ask is because depending on the type of debt will make it clear on what you should obviously be doing. If it is, consumer debt, that debt is not good debt to have. And if you wanted to go invest in something like real estate or something like anything else where you might have potentially need to get a loan, a lender might not like to see you have that kind of debt. Then that is something you need to be considering. You should more likely be looking at paying that kind of debt down, especially if it's high interest debt, like I mentioned. The second question that you need to be asking yourself is, what would you invest in if you were to go invest? This is an important question because the thing that you invest in is going to determine, whether you get in more debt or not, right? Because if you're going to invest in real estate, you're going to have to take out more debt, like I just previously mentioned, right? If you're going to invest in stocks, you don't need to necessarily take out debt. You can just open up Robinhood and just go buy some of those stocks. Or if you're investing in a business, you might have to take out some sort of debt. And so it depends on what you want to invest in. And so that leads me to my third question. Do I know how to invest, right? This is really honestly the yes or no question. Like, do you know how to invest? If you do, then okay, you can look at investing. If you don't, then this is where the video ends for you. I always say education before compensation. And if you don't have the right knowledge and the right education to be investing, you're going to lose more money than you will make. You will get a negative ROI. So you'd have been better off paying off that debt. So what I would recommend in that case is while you're educating yourself, while you're learning about investments, you need to be paying that debt down. That's what you need to be focusing on. So that's the answer. If that's, if you don't know how to invest, go learn how to invest, pay the debt down. That simple. The next question you need to ask yourself is how old are you, or what's your risk tolerance? This is another important question that you got to ask yourself, and this just goes back to knowing yourself. If you're older, then I would honestly be saying that you should be, focusing more so on investing, because you're getting closer to that retirement age and you need to have as much capital as possible to be able to live comfortably in retirement. If you're not looking to, be financially free, we're just considering a normal case. Regular person that wants to do 9-to-5 slavery work. If you're going to be living off that 401k, you need to be focusing on that investing, because you're much closer to that time. So you're going to need that money. If you're younger, it's honestly more of a toss-up, because you can make the case for both of them, right? But I would honestly lean more towards paying off the debt, because you still have time to catch up with the investing side, right? If you're only 25 years old, you have, let's say in the case you wanted to be the 9-to-5 slavery, you still have 40 years until you were to retire. So that is plenty of time for compound interest to do its magic, right? Time is the most important factor when it comes to investing, especially if we're looking at the stock market or appreciating real estate. The more time that it has to build up, the better it's going to be when it's time for you to take advantage or use that money. So if you're younger, I would lean more towards paying off that debt, obviously considering everything else we've just spoken about. Now, the last thing I want to talk about is the special considerations that I mentioned, and that is more specifically taxes. So when it comes to paying off debt versus investing, the tax implications are literally 180 degrees. They're completely different, because you have to understand that the interest on certain loans is a tax write-off. You get to save a portion of that money when it comes to tax time, right? And so when we look at, student loans, you can write off up to, I think, $2,500. Go ask your CPA. I'm not a CPA, but you can write off, I think, up to $2,500 in student loan interest payments that you've made for that year. Now, on the flip end, when you invest, the income that you earn from your investments, that is taxable income. So you're gonna get taxed on that. So if you're considering, let's say you have 4% interest student loans, and you can get 7% in the stock market, and you're considering that 3% net profit, as what you can make, you need to understand that some of that 3% is gonna be paid to taxes. So you don't even technically make that 3%. You're gonna make the effective ROI is going to be a little bit less. So that's the more objective viewpoint on whether you should, pay off debt or invest. So in my opinion, I think that if you are in this predicament, you need to focus on increasing your income so that you can use the extra income to pay the debt off, and then use the money that you already are making, the normal money you were making from your job or whatever job you're working right now, or any way you're generating money right now, use that money to invest. That's the pay yourself first mentality. When you get paid, you should always invest first, because you make investing a priority. Now, paying off debt can also be a priority if you create an asset that is going to pay that debt off. We interviewed Anthony and Janilka Hartzog in episode 38 of a podcast, and they paid off $114,000 of debt in 23 months just by increasing their income by taking on numerous side hustles and starting a cleaning business. Focusing on increasing that income will allow you to continue to live the lifestyle that you want, and not necessarily have to sacrifice in anything. You can invest and pay the debt down. But if you did enjoy this video, be sure to give it a thumbs up. Share this with a couple people that are in the same predicament as you. They got student loans, they got credit card debt, and they don't know what to do. I hope you got some value from this. New podcast episodes dropping every Thursday, new videos dropping every week. Be sure to subscribe, and I'll see y'all in the next one.